Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. I am joined once again by Jason Shapiro, veteran trader and founder of the Crowded Market Report. The first time Jason was on, he was very bullish in, I think, around the middle of 2023. Obviously, that played out well. He was his second time in November. He was also somewhat bullish, although less so. Jason, welcome back to the show. Good to see you. How are you thinking about the markets now as we record this on May 30th?
Which markets?
Stocks.
I'm pretty neutral, I'm pretty neutral. Well, which means that you have to be leaning bullish because the market over time has a tendency to go up. I'm certainly not bearish. I'm certainly not shorting here, but I'm not super bullish at the same time either. I don't really think that there's a lot of edge going on right now.
So you're neutral. Why?
I think what has been driving assets, what's been sort of my narrative for most of this year, was my belief that interest rates were too low and therefore liquidity was very high. And with liquidity being very high and a Fed that doesn't seem to want to raise interest rates to slow down that liquidity, asset prices, I thought, were going to go up because of that. I mean, liquidity is what drives asset prices up. If interest rates are too low, I can't prove that they're too low, but let's just say they were, then asset prices should go up. And my thought process was asset prices would go up and force the Fed's hand to think about raising rates. I don't think we've gotten to where they're talking about raising rates yet, but we have certainly come a long way, right? From 6 rate cut, expectations in January to now what's maybe 1, right? And even some whispers of maybe they're going to raise. So that idea has sort of been very much sucked out of the market. And asset prices obviously did go up. People are like, well, how do you know that there's too much liquidity? Are you looking at M2 or you're looking at this and that? I'm like, I'm just looking at the price of assets. Asset prices don't go up a lot when there's not liquidity. And you look at all these assets, stocks and anything else. Bitcoin's pretty close to highs, stocks pretty close to highs, housing prices close to highs, gold, silver, all these things have been going up. That can't be a lack of liquidity by definition, right? But I think a lot of that's been now sucked out, both market-wise and also psychologically wise. Nobody really believes that there's 6 rate cuts coming. People debate whether there's 1 or not at this point. So a lot of that's been sucked out. So the question becomes, what from here? And I think we're going to have to see. For me, it's always a question of not me predicting what's going to happen, but rather how is the market going to react to what does happen, right? And I think that the key thing is the markets have to move higher should numbers like the PCE number tomorrow come out, slightly weaker. The markets have to move higher on that. And if they can't, then I think there's trouble, right? They have to continue to move higher on that. So let's see how that happens. First of all, let the PC come out weaker. We don't even know if that's going to happen, right? But if these numbers start to come out weaker, then the markets have to move higher. And today, for example, now there was a bad earnings report, but that was a more Dow related thing. But I mean, the stock markets are down. All the commodities are getting crushed today. Well, about a month ago, everybody decided we're going to this new super cycle long commodities, right? I don't think anybody realizes anybody who bought copper in the month of May is now losing money. Copper has become just the favorite trade, and I can get into that in a second, but the point is today stocks and bonds are ripping because we had like a little bit of a weaker number that came out this morning.
For GDP, yeah.
Right. So bonds are very strong. Meanwhile, stocks are not up. And commodities are getting hit pretty badly. I mean, copper's down almost 3%. Silver's down almost 3%. Crude's down 2.5%. Grains are down. So I don't think that that's a very good sign for the narrative, right? If the narrative of lower rates is going to be pushing this stuff up, not that one day means everything, but we're starting to see, and I felt that we were starting to see, starting last week, a little bit of a change in the action there. So therefore, that makes me pretty cautious to neutral here.
So as you alluded to earlier, you are a contrarian, and basically if everyone is bullish, you're inclined to be bearish. If everyone's bearish, that's what is inclined you to be bullish. The very bearish positioning and narrative in the middle of 2023, I think, is a large reason why you were bullish, and that call proved to be correct. So that makes sense to me. And what also makes sense to me is, as we record in the afternoon of Thursday, May 30th, if the inflation data tomorrow on Friday comes in weak, i.e. inflation is lower than expected, i.e. that's a good thing, the market better rally. Because if it doesn't rally, that is a bearish sign. If the market sells off on good news, in the same way that if it rallies on bad news, that's a very bullish sign. That makes sense to me. Explain what you said to me about how commodities are selling off alongside the market, and that makes you somewhat cautious. I noticed for the first time probably 2 weeks ago that copper was actually at all-time highs. And that shocked me because 2 months ago, it was very, very far from all-time highs. So we had a miraculous melt up in copper and some other commodities over the past 2 months. And now they're falling a little bit from those highs. But what specifically is so worrisome to you that the market's selling off alongside commodities?
Copper's become the favorite trade on the planet. There are people that don't even know what copper is at this point. Not that I necessarily do, but people that really don't get involved in these trades that are now involved in copper. People are coming on TV every day saying copper is the no-brainer trade. For the last 2-3 weeks, that's become the thing. Basically, ever since Druckenmiller came out and said he loved copper, we just have people lining up about copper. It's become like the new AI trade. There has to be all this new electricity built, and that takes a lot of copper, and it's just a no-brainer trade. Well, copper's down, I don't know, 10% in the last week. Like I said, it's down it's flat on the month now, but anyone who bought it this month is now losing money. This is the longest. You talk about, like, when everybody's long, I'm looking to get short. When everyone's short, I'm looking to get long. This is the longest in the futures markets that they've ever been in the history of the copper contract. Does that mean it can't go up? No, it doesn't mean it can't go up. You can get more longs, right? But it doesn't make the risk reward very good. And it also means that if it does start to go down, which it is starting to, you have a lot of liquidation that can come. Stops start getting hit, and moving averages start getting hit, and people get stopped, and all that stuff starts to go down. And you have a similar situation in gold and silver as well in terms of crowdedness. Not as much as copper, but they're certainly very crowded. That's the most crowded stuff that I see in the markets right now is the metals, which is why I think that they are not reacting anymore. That's what you want to do. It's one thing if they're crowded. You can't just short it because they're crowded, because things are crowded. First of all, can work for a while. And second of all, they can stay crowded for a long time. And third of all, they can get more crowded, right? Just because 1 billion people have bought copper doesn't mean that 1.5 billion people can't buy copper, at some point. But when it starts to act poorly, when it should be acting well, that's when there tends to be a problem. That's when sort of a good risk reward trade tends to happen at that point, because now it's not reacting well when it should, and you have all these longs, and suddenly they become trapped longs and they start getting stopped out, and there can be a big move the other way. And I think the metals are in that position here. And if we back then into a macro view, let's just say that happens and the metals are going to start to come down. Okay, well then what are people going to start to conclude on that? Copper loses 20%. Well, now people are going to start saying, oh, Dr. Copper is saying recession's coming, and it can all sort of flow through into the whole macro narrative thing, right? On top of that, bonds, which people have now concluded, that they wanted to buy them because they thought rates were going to come down. Now they're concluding the rates are not going to come down, so they've started to sell them. And I would say probably the single worst trader that I know of, got short bonds yesterday on the close. Okay. And
Is this someone you know personally or
someone that I follow.
got it. So they're a public person.
Public person, yeah.
Got it.
Whose trades we actually follow and track, right? And he's just horrible. Not to say he's never gotten a trade right. He has, but he's horrible. So he got short bonds yesterday. And he likes to view himself as a big macro guy. You know, I think personally, I love building macro narratives. I think it's fun. I think it's interesting. I think it's great to talk about. I also think it's probably the biggest money loser that there is, right? Because by the time I can build a macro narrative, or you can build a macro narrative, or that guy can build a macro narrative, everybody else has already got it. Like, you're not coming up with anything new, you know, and so therefore it's discounted in the market. The market's a discounting mechanism, and that's why you get screwed the other way. So this guy did short bonds yesterday, right on the lows. So I think that there's a good chance that bonds are going to rally. So again, if bonds are going to rally, interest rates are going to come down, and let's say metals are going to come down, you can quickly see that suddenly the macro narrative will start switching back again to recession, which people gave up on, in my view, about 2.5 months ago. People gave up on the recession thing, right? That they held on to for so long. That was all given up on. And funny enough, they have all decided to, and I put this on some videos that I did, but because they had this recession view, they were underinvested, they were overcashed, they gave up on the recession view, they had to put money to work, and they don't put money to work in things like Nvidia or Dell or the things that are leading, because they don't want to see us chasing. So they'll put money in the things that are lagging. So they were all talking about it for the last few weeks. Where do they want to put money to work? Industrials, materials, energy, which are all theoretically macro-wise growth investments, right? Mm-hmm. Economic growth investments. So if that's not going to work, right, which it already is not working, right? The Dow stuff is way underperforming in the last few weeks, right? Then again, that can turn into building that macro view of, okay, now recession's coming in, right? Metals down, bonds up, industrial stocks down equals narrative recession is coming again, right? So that's where I kind of think that we are heading. And it's always a bad bet to be short stocks, I think. Not always, but most of the time. So that's not, I'm not really saying, hey, short the hell out of stocks here. But I do think that, and this is not a trading thing, okay? Again, like I say, macro will kill you. But to me, the macro thing is really as obvious as could possibly be here to me. And it ain't good. And that doesn't mean that the markets can't go up. And that doesn't even mean that this, let's say, not good macro thing happens now, or it could be a year or years from now. But I just feel very strongly that the central banks have just painted themselves in a corner. And when, and there's going to be hell to pay. There's going to be real hell to pay, right? And I'm not saying sell everything right now and put everything in gold and, you know, get your guns and make sure you have fresh water and all that.
Canned food, yeah.
You know, now, I'm not saying do that now, because that's silly. But I think that you have to keep it in mind that the central banks have really painted themselves into a major corner, and there is no way out. You can delay it because you're a central bank, but I really think that it's bad. I don't think I've ever seen, one of the things I wrote a couple of weeks ago on my thing was I called it the biggest shit show in central banking history. And I truly believe that. This says nothing about timing, but there is, to me, an inevitability about the end game to this all. So
it sounds like you are cautious to neutral on stocks. You use the word neutral, and on bonds, you're actually bullish because you think whether there will be a recession or not, that the recession narrative is actually underpriced. And as commodities fall and bonds rally, the same people who just abandoned the recession narrative, having held onto it for, close to 2 years, will re-embrace that narrative. So I just want to say, and also I want to say the two previous times you've been on the show, you were bullish. So you are not like that guy who is always screaming doom and gloom, and then you're right because the broken clock is right twice a day. So this I actually I'm paying attention when you who has been very bullish before is getting bullish on bonds instead of stocks. So when you say there's no way out, there's hell to pay, I've never seen something like this. What do you mean?
We have got to a point, it seems, in economic history here where you can't have a recession, right? The consequences are just too dire at this point. There's too much debt out there, right? And you just can't have a recession. So what do? Anytime there's weakness, they just print money, right? Lower rates, print money, whatever you want to call it. They try to create more liquidity. This all started, after the '08 thing, right? Where capitalism essentially failed. And so governments took over, right? So they are in charge now. So, and this whole MMT idea, right? You can print as much money as you want. It's not inflationary. Well, we found out that that's not true, right? Inflation got up to whatever it was, 9% at one point after all that money printing post-COVID. So that's what they do now. That's the new thing now. They will just print money. And you got to remember in '09 when they did it, no one thought it was a good idea and it worked, right? Now everybody believes that always works. And if and when we get to the point, if and when we actually go into a recession, and then they decide that the way out of that is to print more money. In other words, they printed money. It caused inflation, right? They raised rates. Rates can't go down because of the inflation. Now we go into a recession. So what are they going to do to get us out of that recession that they can't have because they owe so much money? They can't have a recession. Well, they're going to print money again, right? Which then causes inflation, which means they can't lower rates. You know what I mean? It's like a circle. It's a Ponzi scheme, essentially, to me, is what it is. It's a Ponzi scheme. And while Ponzi schemes run by individuals are pretty short-lived, a Ponzi scheme run by a government that owns a printing press can clearly last a lot longer, right? We don't know how and when that will end, but it will end. And when it ends, it's going to end badly. The fact that they can extend it longer just means that when it goes bad, it's going to be that much worse. And again, I'm not saying this is today. I'm not saying go out and short everything and run for the hills today, but that is the end game. And so it could be today, right? It could be today, it could be 10 years, it could be 20 years, but keeping an eye on it is important because I just have no doubt in my mind that there's no way out of this cycle right now, Everyone talks about how, well, you can't have an '08 again because the bank balance sheets are so much stronger now. Yeah, because all the debt that the banks were guilty of taking on back then that blew them up has now been transferred to government balance sheets, right?
Correct. So
that's a much bigger problem. I understand the government bails out the banks. Who bails out the government? There is no one, right? So
the central bank.
Who bails them out? I mean, how does the central bank bail out the government? They print money. Okay, it's great. They print money. I get it. Print money, print money, print money. Eventually, that doesn't work. And that's why I'm saying we don't know the timing, but eventually that doesn't work. Go ask Zimbabwe if that works, right? And I know the U.S. is not Zimbabwe. I get it, okay? But it doesn't matter, right? There are certain natural laws to the world that come through anything, physics, economics, anything, right? Supply, demand. If you print eventually too many dollars, eventually people are going to reject them. And there's a limit to everything, including how much money the US government can print. Are we there now? I don't know. The markets will tell us, and they'll tell us when this happens, if we should go into recession, and they print money to get us out of it. And that doesn't work, right? And the dollar starts going down. So it's a huge risk out there. And I never say something's definitely going to happen, but it just seems inevitable to me. Now, I have said that there's a chance I'll be sitting on my deathbed talking to my grandchildren and saying, don't trust the US dollar. It's a fiat currency and it's a Ponzi scheme, and they'll be sitting there rolling their eyes, here goes grandpa again, right? People have been talking about this since the Reagan years, and it's been completely wrong to do that. So you don't trade off of this to me, but I just think every day this inevitability becomes more and more pronounced, and it's all fine. Everything's all fine as long as it's working, right? As long as there's no recession and all that, and they don't have to do this, it's all fine. But when that day comes, it's not going to be fine, and it's going to be not fine to an extent that nobody's ever seen before. It's my view. So that's why I'm constantly on the lookout for the signs of that, such as lower rates today and commodities can't rally, lower rates today and the stock market, can't rally, right? These start to be the signs, and we'll probably get a lot of false signals before it actually happens. You get a lot of that too, but it's definitely something to keep in mind here. People have completely given up on the idea. 2022 is a distant memory at this point, right? I think there's danger out there. I would not be superly aggressive here.
Isn't the Zimbabwe scenario a scenario where stocks crush bonds, though? If there's hyperinflation?
Probably, yeah. I think of all things, stocks are not necessarily the biggest short based on, and I'm not shorting stocks here, and I don't see that stocks are so crowded long or anything that they're giving me a setup to get short. They're not. One could certainly argue that if that happens, you saw it in Venezuela a few years ago, right? Venezuela had huge inflation numbers, and stocks went up like 5 times or something like that, right? Because they're an asset. If your money is becoming worthless, you got to put it into something, right? At least you put it into a company that's real, that has real assets and has real stuff, then that might be worth something. There is that argument. I'm not saying short the crap out of stocks on all this, but as much as I'm saying, hey, bonds are maybe a good buy from here, that's a trade.
That's a short-term view.
Yes. It becomes part of where we are in the cycle. Okay, so bonds are, because we might start to see the recession come now, so bonds are a buy. But then once the recession happens and they start printing money, then bonds are probably going to become a sell at that point.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar-wide MOAT ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? MOAT strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/MOATFG to learn more. That's vaneck.com/MOATFG. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide MOAT ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. And so the individual who not me, but you identified, a few minutes ago as the worst trader ever, worst trader that you observe, and you use him as a counter signal. I believe that individual did an interview with Steve Eisman recently, and Steve Eisman separately, not in that conversation, but separately said something that I think is really relevant and that I really like. He said, look, in the investment business, being early is the same as being wrong. I've been 1 year early. I've been 1 year early. I've been 2 years early, but I've never been 40 years early. And the people who worry about the U.S. debt and who are all doom and gloom about the money printing, the Endgame, they've been 40 years too early, and they should have humility about that. Jason, the 2 times I've interviewed you, I think of you as someone who fades doomeristic narratives, and who, if you always say, look, if the stock market's in an uptrend, likely it's going to be up tomorrow, and I'm going to ride the trend. Why not ride the fiat debt trend of the past 40 years or maybe the past 80 years?
No, you should. You should. I can't, okay, because of my trading style and my return stream that I offer to my clients is not that, okay? But you should. There's no downside to it, because so what if everything blows up? So what? So your stocks go down or whatever, your investments go down, it's not going to make a difference anyway, because it's all going to be worth nothing anyway. So you might as well ride, like you say, the fiat Ponzi scheme. Absolutely. I wouldn't necessarily do it in the metals, But certainly, sure, ride it in the NASDAQ stocks, you know what I mean? And ride it in Nvidia and all this stuff. Absolutely. You know, I've been saying all along that people are like so focused on this, what the next 50 basis point move in 10 years is, right? And that might mean something to all the stuff that they're investing in, right? These industrial names and all that. Does 50 basis points in the 10 years mean a single thing to Nvidia? I can't imagine it means even the slightest thing to a company that's growing and has margins like that, whose clients, you think about who their clients are, you know, the biggest companies, the biggest cash generators in the history of mankind, right? This guy from Nvidia must go to sleep, I always say, giggling every night. You know, he's got these companies that make billions of dollars a quarter, and they all feel like they have to trip over each other to spend those billions on his stuff so that they can keep up with each other. Does the next 50 basis points in 10 years make a single difference to something like that? Clearly not, right? So you're right. I'm begging people, don't like get crazy short stuff because Jason Shapiro says that it's a Ponzi scheme, because guys like Jason Shapiro have been pointing out that it's a Ponzi scheme since Reagan, and it's been completely wrong. You know, completely. Well, it's probably right that it's a Ponzi scheme, but the Ponzi scheme has been able to go on for this whole time, and it could go on for another 40 years. Like I said, I might be sitting here telling my grandkids on my deathbed, right? The same story, right? So you don't trade off of this type of stuff.
Yeah.
You know, you can't. You know, that's why I say trading off a macro view is just dangerous as hell. Right?
When Jason Shapiro tells me he's worried about the end game and the money printing, that to me is not a reason to get bearish. When Jason Shapiro says everyone he knows and every single position is way over leveraged long the stock market, and there's no one else who can get long, that is a time that it might be wise to be cautious on the stock market.
Correct. Well, that's where we are in metals right now.
Okay. And so even after that 10% correction in copper, you're still quite bearish on copper.
Yes. I don't like to say I'm bearish because I don't know which way it's going to go, but I think the risk reward is right, at the very least to not be long, right? And when you want to play short, you know, short's a whole dangerous game that most people shouldn't be doing in anything, but yes, I certainly wouldn't be long that stuff.
Got it. So you're waving the flag on that. So this year and much of last year has been led by technology stocks that are associated with AI, whether they deserve to be or not. And a lot of that has been concentrated in the Mag 7. Well, not Mag, definitely not Tesla.
We're down to about the Mag 1 at this point.
Yeah, the Mag 1, Nvidia. Yeah. And you say, so a lot of people who missed the rally have got they don't want to be chasing the trade. And so they have piled into the things that didn't work as much, like energy or industrials.
They have to put their money to work because they've been sitting in too much cash for too long.
Yeah.
So the psychology clearly is, well, I'm not going to buy stuff that's up 500% since I went to cash, right? I'm going to buy where I see value, you know, and that has consistently, I hear it every day, industrials, materials, energy. And for some reason, they all say it in that order. I don't know if they're all reading the same script or what. No one says energy, materials, industrials. They all say industrials, materials, energy. Like,
is it maybe based on industrials is a larger market cap sector?
I don't know why, man. I think they're all just reading from the same script. I really do. I see 10 people a day get on TV and say that, and they all say it in the same order. I don't know why.
What do you think about Nvidia now?
What can you say? It's the hugest money-making machine ever, right? I mean, the guys are selling picks and shovels, and this is nothing that nobody doesn't know at this point, right? But I mean, they're selling picks and shovels to the future, and their clients are the biggest money machines in the history of mankind, right? So I don't know what AI even is. I don't know what it's going to become. I don't even know if it's real. But what I do know is these people believe that it's the future. These people believe that it's where they have to be investing a lot of their money, right? And they're tripping over each other. Think about if you're sitting here and your clients are Microsoft, Google, Apple, you know what I mean? And they're tripping over each other to buy your products. Like, that's a dream come true. You're going to short that idea? I'm not saying Nvidia can't go down, but there's got to be better shorts in the world than that, is all I'm saying. You want to be short something, there's got to be a better short than that.
Yeah, and Nvidia could definitely collapse in value, but I think for a short, you want it to be where it could collapse in value, but it's very unlikely that it will spike up. And to me, I think the odds that Nvidia just continues to rip higher, it's definitely a possibility. So that means it's not a desirable short candidate.
If you can't come up with a better short idea than that company, then I don't know what the hell you're doing.
I would agree with you.
I really don't. And that's not to say if the stock, look, it's gone up the most. So if the stock market goes down, maybe it can go down the most. That can happen. Okay. But from a risk reward point of view, if you can't come up with a better short than that, I think you're in the wrong business, man. There's got to be a company that's worse than that, right? There has to be somewhere out there. There's got to be some company that's a better short than that, either fundamentally or technically or however the hell you want to look at the market.
So would you say you're bullish, bearish, or neutral on Nvidia? And maybe a sentiment signal for our audience is that I've actually started to pronounce Nvidia correctly. I used to say Nvidia.
Me too. I got called. Didn't you hear me say Nvidia? I get called out all the time for saying Nvidia. People are like, only a moron calls this thing Nvidia. I'm like, okay, I guess I got to figure out what the real name is. Yeah, I'm in the same place. That is a good sentiment check. Now we both pronounce it correctly.
Yeah.
Top is
maybe
in.
It could be getting close.
Top is in. Top is in. I mean, look, am I neutral? But I could never buy that stock here. Okay. But I would never short it here either. Right.
Yeah.
So I guess that puts me at neutral. If I were going to short something, there's 1,000 things I would short before I'd ever short Nvidia.
But you wouldn't be long it. Why?
First of all, I don't trade stocks. So
you don't do individual stocks. You do S&P future index.
I'm a futures trader. But second of all, I wouldn't, if I had done stocks, then maybe I would know more about it. My knowledge of it is very secondhand. You know what I mean? Like I said, I don't really understand what AI even is, but I do understand that people are buying the crap out of their stuff. But is that discounted in? Is it overvalued relative to that? I really don't know because I don't spend enough time looking at it. I did spend a lot of time last year making videos begging people to stop shorting Nvidia.
Yeah.
Which I'm sure you saw, because everybody I knew was shorting Nvidia. And they were doing it for one reason and one reason only, because it went up a lot. That was why they were shorting it, right? Which is just the worst reason. I don't think we're seeing that anymore, right? I think that's gone away, right? No one's doing that anymore, because anyone who's doing that has gone bust, right? Yeah. So those people are not around anymore. No one's shorting Nvidia anymore. So clearly that means the risk reward has changed, right? So I wouldn't be aggressively long the thing here personally, based on how I look at stuff, but even so, I also wouldn't short it.
And how does the performance of very large cap stocks like Nvidia inform your view of stocks in the S&P 500? Because I mean, where Nvidia goes, so does the stock market.
Does it?
It has.
Nvidia's on a new all-time high. I mean, it might be down a little bit, but it was on a new all-time high yesterday. Mm-hmm. The Dow is
Dow doesn't have an Nvidia.
No, I know. But that's the stock market. Things are almost down 2,000 points from the high. The S&P's off highs. And NASDAQ, which is more Nvidia, but was off highs. It was amazing to me how many things. I thought Nvidia Day was a really interesting day, Nvidia earnings day. Mm-hmm. Because clearly you didn't want to short the stock market pre-Nvidia earnings, right? And the Nvidia earnings came out great, as we all know, and Nvidia went up, right? The previous earnings reports came out great, and Nvidia failed. Had a reversal day on the earnings thing, and kind of did nothing for a few months, and then made new highs later, right? Whereas on this one, it went up on the year and just kept going up.
Which quarter? The quarter previous to?
I want to say the 3 previous quarters.
Okay.
All 3 of those was a situation where the stock gapped up after earnings and then failed and went down, right? And that
Okay.
proved to be a temporary high for the stock, not for very long, but a temporary high. So I feel like everybody was thinking the same thing going into this one, because that's what they do. They always like to look at last time. And so they figured, well, let's short it before because it's going to go down after. And then they got squeezed and it just kept going up. But the rest of the market didn't go up, right? Even the rest of the stocks that go with that, SMCI and all these other things, they all went down on that day, right? So this is, I just think it's showing, again, I don't like to get too bearish. I don't like people to get bearish because bearish stocks, as I've said a million times, is just the worst trade ever invented, right? It costs more money, more people, more money than any trade I know of, right? But that's really not a great, I don't think the tape has been great since then.
Got it. The tape's been pretty weak.
I think that the tape has been pretty weak for everything except for Nvidia, right? Including the metals and stuff like that. So, yeah, I'm not in love with the market here. Look, it will either go up or down. Okay, so
or stay
or
flat.
sideways, right? But I don't think that there's great risk reward here. Is how I like to look at it. I like to look at things in terms of risk reward. I don't see great risk reward here. Whereas when everyone in the world is looking at recession and the positioning is showing that everybody is massively short, that's great risk reward, right? When everyone's given up on recession and positioning, while not super long, is more neutral, that's different risk reward to me, by definition. So that's kind of where I think we are in the stock market. Different risk reward, not great risk reward here.
Not great. What does the positioning look like in the bond market?
They are super short, the short end. 5 years and in, people are very short. And they've kind of gotten a little bit, I wouldn't call them long, but a hell of a lot less short in the long end, which would imply some kind of steepening coming up, right? Which you would expect, I think. And this gets into macro stuff that may or may not come true, but you would expect in a rate cut environment, if we do start to get, and I've been anti-rate cut all year, by the way, right? And I'm just slowly, as everybody's starting to go that way, obviously I'm starting to go this way, right? They're not all totally there yet. And so I'm not all totally there yet, right? But as they're going this way, I'm going the other way, right? We're meeting somewhere in the middle of the arc right now. But if there were to start being rate cuts, in fact, then one would think that the curve would start to steepen, which is what the positioning is saying has a good chance of happening. And it's not that the positioning then drives it. It's that once it starts, because of the positioning, it can start to happen pretty quickly because everybody starts getting squeezed and taken out of those positions. It doesn't cause it, but it exacerbates the move once it starts, is how I see it.
So are people more short the short end than they are the long end?
Much more short.
So that would mean that the market is pricing in a further inversion, or for the market to stay inverted. And for that reason, your contrarian view is to steepen, even though I think the narrative is steepen because it always steepens.
I don't know what the narrative is on that. You might be right. The only narrative I hear about the yield curve every day is how this is the longest it's ever been inverted. And, that whole thing. We've been hearing that, it was the longest it's ever been inverted 8 months ago. And now it's 8 months down the line, right? And maybe it just stays that way. Who knows, right? And the 5s, 30s relationship that's going to be a steepener, but is it a bear steepener? Is it a bull steepener? It can happen in a whole bunch of different ways, right? Or it can just sit here and do nothing, obviously. But, I remember JGBs. People were shorting JGBs for 15 freaking years, right? And they would have like a big down day and everybody would freak out. This is it. This is it. This is it. And then it never went anywhere for 15, 20 years, right? We could just be doing that as well. Everyone always thinks there has to be this massive move in things, right? And then it just is not, it's not true. But again, I'm slowly shifting this way as everyone is slowly shifting that way. The same people that were so sure and assured us that there was going to be a recession last year, right, are now buying industrial companies, are now buying materials, are now buying energy, which I think is pretty easy to argue are growth equities, not growth equities, but GDP growth.
Yes.
Equities,
yes.
Right. So when those people are doing that, I don't want to do that. I want to do the other thing. Right. And that's where I think the danger is. And like I say, the real danger is once this starts, if and when this starts, I think that it has the potential to get very, very bad, because I just don't see the way out. The way out is to print money. How are you printing money when you already have an inflation problem? Like, I don't get it. Powell even said it a few weeks ago. He said, we want to cut the balance sheet so that we can build it back up again when we need it, right? He's telling you what they're going to do. They're addicted to this now. This is what it's become. This is what capitalism has become, right? And it's fine. That was always kind of the idea of the government backstop, right? You go into recession. Okay, the government spends money to pull us out of recession, goes into deficit, right? They can use their balance sheet, go into deficit, get us out of recession. And then when we have growth, pay back that deficit, right? And move on. But they don't do that anymore, right? Now we have a problem. They go into deficit, things get better, and they go into more deficit. Right?
Yeah.
That's just not that. I'm sorry. That can't work, man. It cannot work. It's impossible. It's impossible for that to work. Can it work for a period of time? Of course it can work for a period of time. Can't work forever.
The Fed right now is tight in terms of quantitative tightening and high, at least neutral, maybe tight interest rates, 5.3%, wherever it is. But yeah, the government is still running U.S. government is still running a large fiscal deficit, which in an expansion to run a fiscal deficit would be considered pro-cyclical. So it's rather than running a huge deficit because you have a recession and then running a surplus or a less big deficit when you have a boom, an expansion. Yeah, the U.S. is definitely running a large fiscal deficit when the economy is not in a recession. I think the issue would be if interest rates don't go down in a recession. For the U.S., they normally do, because when there's a recession, people get laid off, they sell their stocks and they buy bonds, and inflation falls off a cliff and people buy bonds. I mean, that's just what they do. In Thailand in the 1990s and other countries, they have an issue of interest rates go up during a recession, but that has not been the case of the U.S. historically. But if that does happen, and I'm not predicting it is, that could be an issue.
We're dead. And that is what's going to happen in my view, because they're going to go back to the same idea. They're going to go back and try and print money and deficit spend. And that works when you've built up, a surplus, then you can do that, right? This whole thing is predicated on this government debt now. Since 2008, the whole thing is predicated on this, right? Everything is all predicated on it. And it's, like I say, it's fine as long as it works. But when it stops working, there is no out at that point, right? There's nobody to bail the government out. There's nobody to bail the Fed out. So I think it's very dangerous. I don't want to make the whole bear porn case, like you said. I'm against that. I don't like it. I think it's stupid. I think it's what makes people miss out on investing their money and misses out on them making wealth, okay, and earning wealth. But at this point, you absolutely have to be aware of it. You just have to.
Yeah, I mean, I think it's helpful to be aware of it. I think it's really important for the viewers to get your sort of two contrasting views that may seem like they oppose each other. And in some way, they do oppose each other. I would maybe compare it to a successful sports gambler, of which there are few. Let's just put it out there that 99% of people who sports gamble obviously lose money, of course.
Trading,
trading. What? Yeah, yes, definitely. Although perhaps it's 98% because the stock market goes up over time, whereas the Knicks game doesn't. But
if you're a long-only investor, you make money in the stock market over time because it goes up over time.
Right.
But if you're a long-only investor, you're underperforming the stock market. So that's where you're losing, right?
Oh,
You're
okay,
making
sure. Yeah, yeah.
because you're long only, but the stock market's making 9% a year and you're making 5, right?
Right.
I mean, look, I just did a video last week. We did a thing this year where we're tracking a bunch of portfolios that came out at the beginning of the year. The Barron's Roundtable, right? These are the smartest of the smart, okay? 24 picks, okay? They did 25 total picks. One of them was an international stock. We threw it out. We just took 24 domestic stocks, right? What do you think those 24 equally weighted? If you put an equal amount of money into each one of those 24 stocks, what do you think your portfolio is up this year?
Okay, so first I'm gonna just check what the S&P is up this year. It's up about 12%. I'd say the media that basket is up 9%.
Less than 2.
Oh man, so I'm taking no Nvidia and no tech. They did industrials, energy,
Yeah. Yeah. I mean, I can pull it up.
maybe a Paramount or a Disney.
Yeah, right. All that.
Warner Brothers.
No, that's exactly right. Disney. No, you've been doing this a long time. You're starting to get it. Yeah, no, that's exactly right. Disney, right? All the ones that they were talking about all year, right?
PayPal.
The point is they're up less than 2%. Okay. So you can't tell me that yes, they're up. Did they make money? Yes, they made money. But that's because they're long only and the stock market's up 12%, right?
And those are, I'm sure, extremely smart people who are very well respected.
These are the best of the best, man. They're in the Barron's Roundtable, for crying out loud, right? So anyway, make your point again. What were you saying about the gambling thing? I was liking that.
That it's like a successful sports gambler who, in his heart, he has his macro thesis is that the Knicks are going to win because he's from New York and he loves the Knicks,
Right.
but he's too good of a sports gambler to actually bet on the Knicks. So he's going to bet on the Pacers. In the same way, your macro thesis is somewhat bearish and I'm, somewhat oriented towards an endgame, a doom thing, but you're too good of a trader to actually trade based on that.
I'm not going to lose money just because I might think something. That's really the whole point, right? One of our mantras is be wrong, make money, right? This game is about making money. This is the biggest thing I try to get through people's heads and try to get them to believe, right? This game is not about being right. This game is about making money, right? I'd rather be wrong. I'm happy to be wrong every day of the week if I can make money every day of the week, right? That's what this is about. And that's where I think why people lose money is because they're trying to be right. Like you say, they're Knicks fans, right? Mm-hmm. And so they're going to bet on the Knicks. That's a great analogy because it's exactly right. I'm a Dolphin fan. I don't really bet football anyway, but I would never bet on a Dolphin game. Right? Because I know that I am biased, so plus they break my heart even without me betting on them. So I don't need it, but that's exactly right. It's not about what you want to happen. It's not about what you believe is going to happen. It's not about what you think is going to happen. It's about making money no matter what happens. That's what this game is. And that's where people fail. That's where people, I think as soon as somebody says the words, I think, I'm like, okay, you're done. You're done. You're done. Stop thinking. Don't trade, fade, we like to say.
I think I know what you mean by people who say I think are screwed, but can you just explain that? Follow up on that?
Well, because now they get married to it. Here, I think that this whole thing's a Ponzi scheme and that the dollar is a fiat piece of crap and it's going to zero. Okay? I think that. Great. So now I have to start shorting the dollar and shorting everything. You know what I mean? And like I say, I could have thought that since Reagan, right? And where would that get me? Where would I be right now? I'd be broke. I would have been broke a long time ago if I had been doing that, right? So that's what I mean by I think. It's great. It's all great. I love talking this stuff. I love talking about macro. I find it extremely interesting. Economics, and you know what I mean? I love it. I think it's super interesting. It has zero to do with the trades that I have on. Zero, right? Sometimes I like to build it in my head. I put these trades on because I have a process that I trade. And therefore, I like to picture a macro thing that will support those trades working, right? Might help me sleep at night. But at the end of the day, if the trade's wrong, I get stopped out, I'm out. You know, I mean, I could care less what I think about the macro and all that stuff, right? That's what winning trading is about, right? Not the other stuff, because you're not going to predict the macro. You might even be able to predict the macro. I hear people say it all the time. Well, I got everything right except the market.
Yeah,
Okay.
exactly.
And how'd that do for you? You know what I mean? That's the only thing that matters. There's no futures contract on GDP growth. You know, I got everything right from the market, except the market means you got everything wrong, right? So you may even be able to predict the macro, but the question is what's discounted in? What are other people thinking, right? And that's where the whole discounting mechanism is the whole point of this all, right? There's nothing. I'm certainly not the first one to come up with this whole idea of, you know, the government is screwed and they spent too much money and they're in too much debt. We all freaking know this story, right? I didn't invent this. I mean, good luck and all these people, they all say it. They know it. It's pretty damn obvious, right? It means nothing for where the market's going in any time shorter time frame, maybe even a longer time frame, right? But so that's the point. It's not about thinking about this stuff better than other people, because you're never going to do that, right? It's about making money no matter what. So
right, and being right about an opinion or a view that is non-tradable, in order to monetize that, you have to then express a view that's based on the previous view on an asset class, and that is basically a, you know, fancy word for it is basis trade. So, for example, if you think that the Federal Reserve would have cut way less than was priced in at the beginning of this year, but you wanted to express a view on stocks, then you said, oh, interest rates up, that means stocks down. You would have lost money by shorting stocks.
Amen.
Of course, you can trade interest rate futures, but yeah, being right is way easier than being the market. Jason, just on the view of the stock market, you don't trade individual stocks, you trade futures and stock market indices. But when it comes to breadth, in terms of the S&P 500, how many stocks are up on the year? Do you have any views at all on that? I'm just looking, for example, that 200 stocks of the S&P 500 are down on the year, while the S&P 500 is up 12% on the year. So it is quite concentrated. Is there anything you can glean from the breadth of the market or which stocks are leading that inform your view, or no?
I know that we can go back and look at some pretty historic market tops and see that breadth had been declining going into those market tops. Okay. The 60s, right? The late, when we went 68 or whatever, the market topped, and it didn't come back till 82. And for the last couple of years, the breadth argument was there, right? Going into the 87 crash, the breadth was weakening, right? We know that. That's problem number one, is that we know it. People have been talking about this breadth argument now for as long as they've been talking about the yield curve argument now, right? Again, discounting mechanism, right? I personally think that once the breadth actually does pick up, that will be the top, right?
Really, why?
Because then you got nothing left to go up, do you? Right? Once everything goes up, what's left to go up, you know? Also, that's sort of the contrarian fate at this point, but I would not trade it based on breadth. I have no doubt that if the market is going to top at some point, it will top after some weak breadth. I'm sure it will, but the weak breadth could go on for 2 years. So how does that help? And it already, in fact, has been going on for 2 years, right? And the market's essentially on highs here, so are pretty close. So how has that helped us? I don't think that that's helped us, right?
Yeah, and if every stock is going up, and the most speculative, shittiest stocks are going up the most, that is a top signal.
Yes, but is that what's happening?
No, not at all. No, breadth is narrow, right?
The least shitty stock, or at least company, is going up the most. You can say what you want about Nvidia stock. You can tell me it's overvalued. You can tell me it's overbought. You can tell me it's over everything. You can't tell me that's a shitty company.
Yeah, the revenue for Q1 2025 was up it was up 360% year over year.
Right. And the number is $30 billion.
$26 billion.
How much?
$26 billion
in a quarter.
In a quarter. From $7 billion to $26 billion.
$26 billion in a quarter.
Yeah.
You know what I mean? Like, these are numbers. I don't remember if it was you I was talking to about this at one point, but I think Rockefeller died. And when he died, he was apparently the richest man on the planet. And he had what they equate to the equivalent of $28 billion when he died.
Yeah.
This is a man who, whatever, ran the oil business and all these other, right, these businesses, right? All while America was growing. $28 billion is what he died with. There was one day where Facebook went up X amount after earnings. Zuckerberg made $28 billion that day. That's the world we live in, man. You know what I mean? These numbers are freaking outrageous. They're outrageous. And does that mean it's speculative and it's bubble and all that? I don't know, but it's certainly different. You know what I mean? These companies are you know, Rockefeller had to have all kinds of money spent on whatever, oil rigs and, you know, all this stuff. These guys are on the internet, man. It costs nothing. You know what I mean? Relative. I mean, Nvidia.
Yeah, their gross margins are like
75%.
Yeah.
That's outrageous. What business has gross margins of 75%? Much less a business that's doing $30 billion a quarter in revenue. It's outrageous. And people want to make the bearish argument that that has to come down. And it probably does, right? But again, who doesn't know that? You know, is that not already discounted in that hasn't come down? We'll find out. But again, I don't think that that's the place to be short. You want to be short, be short. I wouldn't be short that shit. Like I said, there's got to be a million things you'd be short before you were short that.
Right. And I want to correct myself. So the year-over-year revenue increase was 3.6 times. So an increase of 260%. So only 260%. But yeah, I mean, I don't think they're going to continue to grow 260% year over year, but if they only grow 80% year over year.
I mean, at a certain point, all the money in the world will go their way. Although maybe that's where we are going. Maybe all the money in the world is going for them. They're like Skynet, man. I mean, they're like Skynet at this point.
Yeah. I mean, I hope that we don't get that Terminator scenario.
I'm old enough. Bring it on.
I'm not.
No,
so do you any views in the foreign markets, Hong Kong stock market futures, the Nikkei futures, or the Japanese government bond market? You referenced earlier that people were short JGBs for a really long time. It didn't work. It finally is working. The 10-year is above 1%.
Yes, it is. After 30 years. Yeah.
Yes.
Yeah. I don't really have a big view there. I don't trade those markets. I'm not a big believer and never have been a big believer. And I lived in Asia for a long time and I lived in Hong Kong for a long time.
I know. And
I've never been a big believer in China. And that's not to say that Chinese stocks haven't had times where they've gone up a lot. You know what I mean? I do not think that China is a great long-term investment personally, after having observed firsthand how business is done there.
What do you mean by that?
I mean, it's socialism. You know what I mean? And it's cronyism.
Yeah.
It's not free marketism, right? It was with the internet stuff, and those stocks did very, very well for a while until they stepped in and threw Jack Ma out of the country or whatever the hell they did, right? And then they all came back down, Tencent and all those stocks, right? While it was free, they were great, but then the government stepped in and said, okay, enough's enough, right? I'm not a big believer, a long-term investor in China. It's not, look, I have a lot of friends that are Chinese and I love them, great people, but I personally would not be a long-term investor in China, not a believer. And Hong Kong, you know, when I was in Hong Kong, I was there in 1989, 1990 or something like that. By 92, the Hang Seng was at 12,000. Right? This is right when things started to open up. Deng said, to be rich is glorious, was the big line. Barton Biggs said he is overfed in China, and the Hang Seng went to 12,000. That was in 92. Well, the Hang Seng's at 18,000 now. So it's gone up 50% since 1992. And at the time, as a young guy, right in the middle of Asia, right in the middle of all this, it was clear that China was going to take over the world, right? It was clear that that's where things were going. And by the way, I went to Shanghai in 1994 or 95, and it was a backwater, right? I mean, it was nothing. There was nothing there. I stayed at the Portman Shangri-La, which was essentially the only hotel that foreigners were allowed to stay in. It was like an 18-story hotel and was like the biggest skyscraper in the city in 1994, 95. I went back in 2008 and it was the biggest city on the planet, right? Skyscrapers as far as the eye could see, right? So you had the greatest growth story probably in the history of the world. And the Hang Seng is up 50% in that time period.
Mm-hmm.
What's the NASDAQ up since 1992?
A ridiculous amount.
You know what I mean?
Yeah.
So to me, no, that's my answer. Can you trade it? Sure. You know what I mean? But why?
And do you follow it as a trader or no?
I follow the Hang Seng a lot just out of old habit.
Mm-hmm.
It used to give great signals. It used to trade very correlated to the US. So there used to be a way to play those off each other. That went away probably 7-8 years ago. So that doesn't work anymore. But I do watch it just out of old habit. You know, I watch the Nikkei, I watch the Hang Seng, I watch China, I watch to see how they're doing. But it doesn't have very much of an effect over what the markets that I trade are doing, really.
Got it. Do you have a view on anything that we haven't discussed so far outside of stocks and bonds? And the copper and the metals.
And metals, yeah. Not really. Not really. Not really. I think my view is to watch the reactions. You know, you have to watch the reactions. That's what's going to tell us what to do, right? So far, numbers come out a little stronger. You know, we get the bonds down, the stocks maybe down, the dollar maybe up. You know, stuff comes out a little weaker. You get the bonds, you know, up, the stocks up, commodities maybe up, right? I think what you want to watch for is when that starts to break down. That's when you start to see a change in what's happening. And like I say, today is one of those possible days because you do have bonds up a lot and you have stocks down and you have commodities down. That shouldn't be, you know, that should not be, right? Somebody has to tell me why copper's down today.
Wait, copper's down, bonds up, stocks down. Why does that not make sense?
Because if bonds are up, that's implying lower interest rates. And that's supposed to be what's driving both the stocks here, right? And the commodities. That's what's supposed to be driving it, right? It's these lower rates. If rates are going to be lower, then there's money out there and liquidity out there to drive all this other stuff higher. That's what's been happening. That has been what's happening, right? And there's a bunch of narratives that I develop in my mind. That's the one that's been working. So that's the one I've been writing, right? But that narrative today, and again, today's only one day, but it's breaking down today. Bonds are up. This is the best day bonds I've seen in a while, right?
Yes.
And stocks are down. And
commodities down, bonds up does make sense because to me at least, because when commodities are down, it's going to be bearish for inflation or lower inflation, and so bonds do well with low inflation and they do badly with high inflation. What may seem weird to me is commodities down, stocks down.
I mean, what you're saying is looking at it from the other side. Commodities are down, therefore inflation is down, therefore bonds are up.
Yeah.
But that hasn't been what's been going on, right?
Okay.
What has been going on, and I'm not going to argue with you, that can be a correct interpretation, but what has been going on is bonds up, interest rates down, driving money into assets, creating liquidity, driving money into assets, driving them up, driving up gold, driving up silver, driving up copper, right? That's what's been happening. So that looks like it's not happening anymore.
But this year hasn't all assets been going up as bonds have sold off, not rallying. Bonds have sold off, right?
Assets have gone up as bonds have, assets really started, those metals assets and whatnot really started to rip when bonds started to bottom in April, right?
Okay.
That's when the commodities really started to rip. But you're right, having said that, bonds did top basically the last week of December. And while they've been going down, stocks have still been going up, right? And these assets have been going up. So that is a true statement. But and my excuse for that, or my explanation of that, is that rates, like I was saying, I just believe that rates are still too low. So until they get high enough to choke this stuff off, these assets are going to keep going up, right? And that was what was going on. It just seems like that is not going on anymore. But look, maybe if bonds are going to keep going up, maybe this is just a one-day thing today, and these stuff will just go right back up. Who knows? We'll see. But I wouldn't be long the metals, like I said. So tomorrow will be cool because we'll get a number, and I'd like to see that number come out weaker because then we can get a good look at how people want to react to that, right? There's going to be a point, if these markets are going to top, where they are going to not go up on better than expected inflation numbers. And that's when I think the potential for trouble comes in. Might not be tomorrow. Maybe we get a weak number tomorrow and they all go up. Okay, we're back to normal. Or maybe we get a stronger number and they go down. Okay, that's kind of normal too. But I like to look for when the market does what it's not supposed to do. Mm-hmm. I think that's when the tape is giving you a hint as to what is going to go on. So let's see. Let's use PC tomorrow. It'll be interesting.
Yeah, let's check that out. And the rules, the correlations constantly change. You pay a lot more attention to them than I do. But I know stocks went up as bonds rallied from November to January, February, and then stocks went up as bonds sold off from February to now or to April then. So yeah, the rules constantly change.
No, they did. You're right.
Because I know you pay a lot of attention to the narratives and you watch a lot of financial TV. One thing I observed a few days ago is, so the Dow Jones, as we mentioned earlier, does not have Nvidia for that reason or for other reasons. It's lagged the S&P 500. And unlike the S&P 500, which is, maybe 2% off its all-time highs, the Dow is actually about 5% from all-time highs. But if that's 5%, that's not a big deal. And I saw, on TV, people were like, it's all down 500 points today. And I just thought to myself, like, there's something a little bit babyish about it. And I don't mean that in a bad way, but I just mean like that a very small move can, it's TV and like my show, we dramatize stuff to get people excited and get people interested. But is that a signal, bearish or bullish, that people are getting at least performatively freaked out over a 5% off on highs?
I think it's bullish. Someone said that on our Discord just yesterday, which I thought was great. He was like, the Nasdaq's like a 1.3% off its all-time highs, and everybody on here is freaking out. Yeah. So it just shows you. That's why I really don't think that it's time to really go short here, right? I don't think this is the all-time high here. It doesn't feel that way to me because of reasons like that. It's funny. I think in '87, when the stock market crashed, the Dow lost 570 points or something like that, I'm guessing. That's just like a day's pay nowadays, right?
Yeah.
We go through an '87 crash basically every day, either to the upside or the downside, right? Maybe not every day, but
in points terms, not percentage terms, obviously. And that's why I don't like talking about points.
No, but you're right. Clearly, percentage terms is a lot less, and that's the point. But you're right. Every time the market goes 500 points, people are like freaking out, right?
Yeah. It's 500 points sounds like a lot, but it's really not.
It's nothing. It's nothing. I always think of when '08 happened. The one day the first day, bad day, the Dow was down like 500 points. And I went to my daughter's basketball game that night. And I specifically remember this guy coming over me and go, man, the Dow was down 500 points. There's just something about that number, 500, that people love. '87 was 500 something points, but you're right. It's meaningless nowadays, 500 points. I mean, talk to me about percentage. If it's down 5% a day, hey, freak out, right? But 500 points on 40,000 points, it's silly. You're totally right. It's silly.
Well, Jason, final question for you.
It's a bullish sign. People are looking to freak out. People are still looking for my thing, right? Which is the world's coming to an end, and here it comes, right? And that's a bullish sign to me.
Yes. Yes, good to know. Final question for you is, sounds like on a short-term trading basis, you do prefer bonds to stocks, even though you recognize the objective truth that in the long run, stocks crush bonds, and in the long run, shorting stocks is a very bad proposition. Not that you're saying to short stocks here, but in the short term, it sounds like you prefer bonds over stocks. What would have to change for you to once again favor stocks over bonds?
I guess the positioning would have to change quite a bit. I have to see people, and they are starting to, even like on the AAII thing was was taken down quite a bit this week, right? I'd like to see people get more bearish stocks. I feel like they have gotten a lot more bullish. They're not max, but I feel like they've gotten a lot more bullish here. Although bullish the wrong areas. Bullish the Dow stuff, not bullish the tech stuff, right? Is what I feel like. I would have no problem stocks over bonds, NASDAQ over TLT. I don't know if you go look at the NASDAQ over TLT chart. It's one of the greatest charts in history.
Yep.
All it does is make new all-time highs, like for years and years and years.
And a few years ago, people were saying, well, if you think inflation is going to be low, just buy bonds. Don't take the risk of NASDAQ because because in 2021 or 2022 they traded the same way. But
no, and it wasn't long ago that people were saying, oh, well, these NASDAQ stocks are long duration assets because their earnings are so far out. So therefore, they have a big sensitivity to interest rates. Well, that's turned out to be complete bullshit. Now they're saying that, oh, well, these NASDAQ stocks are actually a flight to safety because they have so much cash.
Yeah. So they're short rate. Yeah. And the narratives change constantly. So what was bullshit was to say that trading correlation, which was true in 2022, would stay forever correct. I would say that on the fundamental case of, if everyone was a valuation traded, like Tesla or growth stocks, a company that has zero revenue should be more sensitive to changes in interest rates because of the discount rate than a coal company that has a PE of 3. But that just because that makes sense in, people who went to Wharton's heads does not mean that the market trades on that all the time. Definitely not.
It doesn't. The market doesn't trade, like you said, correlations move all the time, right? And it's only the narrative afterwards that people are using, right? Oh, well, they make it up later, right? And then it goes bad because they've all discounted that in, and then they make up the next narrative. And that's what I'm trying to do when I do my macro stuff. I'm trying to get in front of what the next narrative could be. I'm not saying this is what's going to happen because I'm a great macroeconomist. I'm saying people are way too long this stuff, metals, right? So I think that they're going to go down. And if they go down, then the narrative at that point probably becomes there's going to be an economic slowdown, right? I'm not saying there's going to be an economic slowdown, therefore metals are going down, right? I'm saying there's a high probability from what I look at that metals are going down. Therefore, the narrative, once they do, is probably going to be that there's an economic slowdown coming. I do it backwards.
That makes sense. Jason, a pleasure speaking with you. People can find you on Twitter at Crowded Market Report. Just give people a quick briefing on what people get from the Crowded Market Report, why you started it, and what services you offer.
Crowded Market Report was started a few years ago after I was in Jack Schwager's book, and a lot of people were coming to me asking me for advice, how to trade, can you teach me, can I work for you, blah, blah. I'm one of those people. I told them I'd love to do that, but I don't really have the time. I can't teach 200 people at the same time. So he started this webpage for people to come and do that. We produce a weekly newsletter is how it started, which is really a newsletter that I have written for myself every weekend just to keep me in check as to what I'm looking at, what trades I want to make, keep my process in check and keep my discipline in check. And then I also have always written macro stuff on there too, doing it the way that I just spoke about, mostly so that I can go back in time and look at how wrong I was, because that's a great place to learn. This newsletter is essentially my trading diary for 20 years. So we give that on the weekends. We do a Discord so that everyone comes on Discord. We talk about the markets. We talk about different trades, different trading ideas. We do weekly Zoom calls on Friday night to talk about the positioning data when it comes out. We do them on Sunday night to talk about what we're looking at the coming week based on all these different ways of looking at the market. What's discounted in, what's the positioning saying, what's the action saying, that kind of thing. We have developed some trading view indicators that our people get if you're on trading view for positioning data that you can download onto your trading view and see the positioning stuff. Yeah, and I want to say to people, I know people join these services all the time, and we are not trying to be, and I never want this to be, a tip sheet. That's not what we're trying to be here, right? This is not about, hey, Jason Shapiro was a market wizard, so what is he saying? Is he saying buy S&P, so I should buy him? Is he saying sell S&P, I should sell? It's not supposed to be about that. I do show the trades that I'm doing based on my process, but I also try to get through to people that my process is not your process. nor should it be, right? I have a very specific process that creates a very specific return stream, which is a negatively correlated return stream for institutional investors that are looking for negatively correlated return streams for their portfolio. It's probably not what your goal is in trading, but the lesson is that in all the things that I do and in watching my trades and how I trade, I'm trying to get the point of what's important to people, which is 1, discounting mechanism, 2, and how to measure that, 2, process, discipline, risk management. These are the things that matter, right? Not, hey, come and trade like me. It's, hey, come and trade like you, but use these lessons that I need to keep my stuff good, to keep your stuff good. That's really what this is about. We're trying to help people. Like I say, we're trying to teach people to fish rather than give them fish, right? So if you're looking for a tip sheet for someone that's going to turn your $10,000 into $1 million over the next 6 months, by all means, go somewhere, go to someone that does that. That's not what we do. Once you've done that and you've lost your money, because that never is going to work, and you still want to trade and you want to really learn the principles of what successful trading is, then maybe check us out, because that's what we try to focus on.
There we go. Jason, thanks for coming on, and thanks everyone for watching.
Thanks for having me, Jack.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.